Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome back to the 92nd episode of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in our world of financial markets and financial planning. So good morning to you, Matt.
Good morning, Mark. How you doing?
Good. Were you happy with the outcome of the national championship game last night?
I was. That was my original winning pick.
Baylor in your bracket?
That was my winning pick of the 64. And I picked it.
It really wasn't. I didn't watch any of it. I was already in bed, but it looks like it wasn't even close.
Yeah, and this is what I've been saying all season. You know, Gonzaga has not been truly tested in down big in a game and having to come back to that degree.
Right.
And that was the whole reason I picked Baylor to begin with. They were battle tested.
No, there you go. Did you finish first in your bracket?
No, I didn't. I came in third, believe it or not, because another family member did so well in the first round with all those upsets.
Gotcha.
Yeah.
Gotcha.
But also for the record, I did not stay up for the game. I watched till halftime, and then I had to go to bed at 11.
Nice. I was watching my New York Mets with their first game last night before I hit the hay, so I didn't even turn it on.
Real quick, how they looking?
They're looking good. They lost. I went to bed. It was 2-0. Then they lost like 5-3. So, disappointing.
Oh, well.
Yeah. What are you going to do?
What are you going to do?
All right. Well, getting back to the markets, Matt, we'll go over performance for the month and the year. And these numbers are as of the close on April 5th, and the data is from Koifin. S&P 500 index is up 1.44% for the month and up 8.57% for the year. The Dow up 1.13% to start the month and up 9.54% for the year. The NASDAQ Composite Index up 3.46% for the month and 6.34% for the year. The IWM ETF that tracks the Russell 2000 Index is up 0.55% for the month and up 14.75% for the year. The Vanguard International ETF ex United States is up 1.1% for the month and up 6.8% for the year. The 3-month T-bill yielding 0.03%, the 2-year Treasury yielding 0.17%, and the 10-year Treasury yield sitting at 1.69%. Big news from the past week, Matt, is the big one was on Friday when the markets were closed. Non-farm payrolls rose by 916,000 in March versus estimates of 675,000, and the unemployment rate dropped to 6%. So gains were strongest in the leisure and hospitality, which saw a gain of 280,000 new hires last month. And as a note, the unemployment rate was down to 3.5% prior to COVID. But
so it continues to kind of make up some lost ground, per se.
We're making it our way back there, yeah. U.S. daily COVID vaccine doses eclipsed an average of 3 million per day over the past week. And as of April 3rd, about 31% of the population has received at least one vaccine dose, and 18% of the population has been fully vaccinated. And this data is from the CDC. So more signs of things getting back to normal, or at least things getting back open in the economy.
I'll throw something out there real quick, Mark. My perception is that the market is now, quote unquote, I think dialed in or calibrated to this, vaccine herd immunity timeline. And I think, earlier in the first quarter, that wasn't the case. And just an observation, my opinion, I think that, in my opinion, COVID vaccine is baked into the market right now.
Yeah, I think it is too.
It's a good way of saying it.
Yeah, so I think people have to be prepared for us getting another surprise and things not going as good as people had hoped or people think.
Yeah, I got that. That's a good way of saying it, Mark, because I think in essence that it's priced in that this is going to continue at this rate, in my opinion, and that the potential surprise is to the downside, not the upside.
Yeah, I agree with that.
That's a good way of saying it.
Yep. So lastly, before we move on, President Biden had started pushing an infrastructure spending bill last week with a speech in Pennsylvania, and his plan includes a proposal to raise the corporate tax rate to 28% from 21% currently to fund the package within 15 years. If this is passed, the combined federal state corporate tax levels in the U.S. will be back to the highest rate among OECD nations, which stands for the Organization of Economic Cooperation and Development, is a intergovernmental economic organization with 37 member countries founded in 1961 to stimulate economic progress and world trade.
So go ahead.
What I thought was interesting, too, I think I just saw yesterday, Janet Yellen.
You're already ahead of me.
Suggested a worldwide corporate tax,
or in essence, to be more
or
minimum
world
in essence,
tax.
because her argument was this could be a quote unquote multi-decade race to the bottom, right? Who can have the lowest tax rate to attract, the corporations, and that's not a good way to start the conversation, in my opinion.
Yeah. So so if this happens, if, corporate tax rates go from 21 to 28%, how big of effect do you think that would have on markets?
All right. My 2 cents is I think a higher tax rate is to a certain extent baked into this market as well.
Yeah.
I look at it from the optics of, would a 28% rate, if it were passed next week, quote unquote, shock the market? And I don't think that's the case. I think that the market is expecting higher corporate taxes. And, right now, I'd say, if I give you my best guess, 25% is already baked in. And I think the more that the infrastructure spending bill is discussed, and the more this gets out there that we're going to a 28% tax rate, the more it's going to get baked in. It's no surprise that we're going to be, if this passes, on the highest tax rate of these developed countries. No surprise. Ultimately, I don't think it's going to derail the market, in my opinion.
No, I don't think so either, because I think what a lot of people don't understand is if you look at the infrastructure bill that Biden put forward, is that there is a ton of government subsidies for a lot of industries that are going to need to participate in this repair of infrastructure in this country. So I guess that somewhat is going to be offset initially, I think.
Yeah.
So it's not going to be like, they're going to hike tax rates and then there's going to be nothing to offset some of that, I think. So I don't think it's going to be as intense as some people think when they just say, oh, corporate taxes are going from 21% to 28%.
Well, we got to remember, prior to 2016, we're at 35.
Right.
And, we made some pretty good
returns. The market still did fine.
Made some pretty good returns before that time period, too.
Right. Agreed. So I don't think, this isn't a situation that I think people should be making, buy or sell decisions around, in my opinion.
I'm 100% in agreement. And again, as each week passes, that rate, in my opinion, is getting more and more baked into the market.
Yeah. Moving on to tweets, articles, and research from the week. I'll let you lead it off.
You got it.
Jay.
I got some goodies for listeners this week, Mark, and I think you'll enjoy it too. First I have is a housing update from Compound Advisors Research. They had a note out, Mark, on April 3rd, okay? The chart they showed went back to 2003, and it shows the year-over-year changes in house prices. Now, the specific index it's quoting is an index called the S&P Case-Shiller U.S. National Home Price Index, okay? The housing boom continues with an 11.2% spike in prices over the last year. That is the largest year-over-year increase, Mark, since 2006. I'm going to throw that out there. Now, it does show some of the largest metro areas within the U.S. This is interesting. Over the past year, the metro area of the 20 largest in the U.S. that had the most appreciation was Phoenix, coming in at 15.8%, and dead last was Las Vegas at 8.5%. Kind of interesting. But again, the median was around 11. Now, here's the really interesting statistic. We are now down to a 2-month supply of existing homes. We got down to 3.5 months or so back in 2005. And I have the chart for our internal notes going back to 2000. I mean, this is quite the lack of supply in the marketplace.
And can you just explain what you mean? But what, like 2-month supply of existing homes? What do you mean by that?
It's a good question. What it does is the simulation looks at the average number of homes that are being purchased on an ongoing basis, and it extrapolates how much it would take to get through that inventory at that rate.
So for supply to go to zero, essentially.
Correct.
Okay.
Of what's out there. Mm-hmm. Now, the average, to give people a feeler, is almost 6 months, 5.618 months to be exact. And that's the average. And we've been under the average mark since 2015. Okay, that's the first thing to throw out there. Now, let's give some listeners perspective back to the great financial crisis, because I think a lot of people, they see how good real estate is now, and they remember how tough it was back in the late 2000s. And home supply at that point, at the worst point, got to 12 months. Mm-hmm. Okay. And what was really neat about this, that didn't peak until 2011, multiple years after the financial crisis. I thought that was interesting too.
Yeah, I think it is too. And I think, this is something that, may or may not last longer than people expect. But I think everyone is looking at it like the housing crisis and saying, well, this can't last for another 2 years. Something's going to happen. Prices are going to fall crazily. And, the other side of it is just being open to the fact that it keeps going.
Yeah,
because we have a very tight supply chain right now. We have very limited supply. We have very cheap money. So this all is, until any of those things change, it points to higher home prices.
Yeah, let's go back to 2007. I don't want to oversimplify the conversation, but people were getting loans for a house with no proof of income. Okay? So they were buying an asset with no money down, showing no proof of income. And if you talk to anybody who has did a mortgage recently, it's not easy peasy. You got to prove all that stuff.
Yeah.
Right? You
Arm, a leg.
Yeah. It's a lot of due diligence that they do. And so what I'm getting at is when someone says that to me, I go back to 2007, and a lot of people thought it was just going to continue to run. And the mere skepticism of it tells me it's going to go more.
Right. Yeah, I agree with that.
Yeah. All right. So I want to throw that out there. I thought it was real interesting statistics on, again, how much supply of homes, what you're seeing in price increase spikes year over year. We're hitting a high since 2006. The last comment I'll make regarding housing is, remember, listeners, a lot of these raw input costs, things like lumber, are through the roof. And if those price gains continue, it will start to really make the affordability of a new housing build a lot harder. And so one of two things are going to happen. Either existing home prices will rise more to meet and match that cost, or you're going to see raw input prices go down.
Yeah.
One of the two have to occur. Mm-hmm. Okay. Any comments you want to make on that?
No.
Okay. I got one more big picture topic I'd like to bring up to listeners, Mark, and this is kind of an update on U.S. manufacturing. Okay. Now, this is also a note from Compound Advisors on April 3rd. The highest level we are seeing currently, the highest level of manufacturing activity since 1983. Now, the index specifically we're talking about is the U.S. ISM Manufacturing Purchasing Managers Index, or PMI. And in my opinion, the COVID-related quote-unquote bottlenecks are being worked out, it seems. This data, to me, is not bearish, Mark. Mm-hmm. Okay? The other thing I want to throw out there is prices paid component is near a 40-year high, providing further evidence of short-term rising inflation. So again, people want things. Let's just take lumber as an example. They got to do that. They're going to pay the price. And you and I are poster child number one example.
Yeah.
Because we are doing an office expansion here. It takes raw materials. We had to redo the subfloor. And guess what? The price was probably triple what it would have been pre-COVID. guess what? We don't have a choice.
Yeah, exactly. And I think where a lot of people are painted into the same corner where they already have this stuff in the hopper and going that they can't just be like, oh, lumber's triple the price. I'm not going to do it. I'm going to wait. Yeah.
Yeah.
So, so it's going to be interesting to see how that all plays out. But I think that's just something that could last a lot longer than people think.
Yeah. So the tea leaves, the data, quote unquote, tea leaves are not necessarily bearish. I've highlighted a couple that are bullish. I'm not saying everything's bullish on the economic data front, but it definitely points to a continued recovery, in my opinion.
Yeah, and it's going to be interesting with earnings coming up here to see comps from 2020 starting.
Ooh, that's a good point.
So that's going to be interesting to see if companies surprise to the upside or if they can't beat their comps from last year. Especially the tech companies are going to have a really tough time, I think. Some from beating their comps because, they had obviously a standout year last year with everything going on.
And then on the other side of the coin, listeners, I would be, it'll be very interesting to watch some of these quote unquote reopening stocks and their earnings coming up here, because I think you're going to see a very big difference between what they report, what their balance sheet looks like, and some of the recent knife catching of some of these names.
Yeah, and it's going to be interesting to follow, which is going to get started here in a few weeks. So
back to you.
We'll stay on top of that.
Yep.
First thing I had was a tweet from Colibri Trader on April 2nd. And he said, don't try to understand each and every market move because to understand is shallow. Try to follow your rules instead, and the understanding will follow. So I just kind of like this because, we've talked about this before, Matt, is that I think everyone gets too wrapped up in the why. Why is the market up 1% today? Why is it down 5% in the last week? And there are so many different factors that go into that answer that you're going to drive yourself crazy.
It's not a one sentence. The media wants to label it. It's because of rising rates this week. It's because of the jobs report last Friday. They want to assimilate a narrative in one or two sentences. And Mark, you're exactly right.
Yeah. So it's just like, people keep contributing to your 401k, keep getting matched by your employer, keep contributing to your Roth or traditional IRAs and your after-tax brokerage accounts and all that stuff, and it'll take care of itself. I wouldn't read too much into the tea leaves, so to speak, with all this stuff going on with why are markets moving. It doesn't, to most people, it doesn't matter.
I'll just add one thing to this. I could get you a chart of the S&P for any time period, 5 years, 10, 20, and I could show you a list of reasons why the market sold off or people became concerned or worried. And each one of those events at the time will seem like it's a major thing.
End of the world,
quote unquote. And guess what? The market's higher.
Yeah.
And so that goes back to a point you have driven home to really help our listeners out, which is stick to their plan.
Yeah. Yep. Absolutely. Next thing I had was from a tweet from Macro Charts, also on April 2nd. So he tweeted a chart of the SOX, which is the semiconductor index, and he said this: SOX just gained 9.5% in 1 week, one of the biggest moves ever, in the top 3%. Price thrusts usually trigger a start of massive rallies, especially in bull markets. Critically, this is the second thrust triggered in 3 weeks. Follow the trend, this could be a big one. And what he means by like price thrusts, it's these big, large gains within a short amount of time, within a couple days or a 1 week period. And I think what we saw, Matt, is we saw several of these in the major indexes coming off the lows in 2020, that you saw these same bullish price thrusts that typically start new legs up in the market. And I think with the semiconductor index underperforming over the past few weeks, now seeing these bullish price moves, I think that's very, very optimistic going forward because, in this bull market, semiconductors have tended to lead the market higher. And they just closed at weekly record highs last week, right? And I think people have to remember that, Semiconductors aren't just in computers and phones anymore, right? They're in cars, they're in appliances, they're in virtually almost everything, right? So, and especially, again, coupled with the tight supply chain right now, these semiconductor manufacturers have price control. And, I think this is a notch in the belt of the bulls right now. If you see semiconductors breaking out to all-time highs with these bullish price thrusts, and again, with the tight supply chain that we're experiencing right now, I think that the path of least resistance, at least for now, is higher, which is positive for the general market.
Very well put, Mark. The best suggestion I have for listeners is rewind this podcast 2.5 minutes. Listen to everything Mark just said. I would agree that I think the SOX right now is a leading indicator for the market, especially the NASDAQ. I think it bodes well for April here going into earnings season, in my opinion. And I can't add anything.
Great.
Perfectly said.
So moving on to the financial planning topic of the week. And as I mentioned last week, Peter Lazaroff from Plan Corp wrote a series of blog posts that highlight the most important financial decisions to make depending on your age. And last week we reviewed investing in your 20s. And this week we're going to discuss investing in your 30s.
I'm only in this for just a little bit longer, buddy.
You're still there, though.
Hanging on by a thread.
So Peter starts off by saying, your 30s are the time to begin building lasting wealth to meet life's growing demands. Here are 6 ways to focus your investing strategy as you navigate your 30s. Consolidate your investments. If you started investing in multiple accounts in your 20s, your portfolio may be in disarray now. You might have 401k accounts with a few employers, a Roth IRA that you started right out of college, and some online investments you built up over time. Now is the time to consolidate those investments, pooling them in one place. With the help of a single advisor, makes it easier to see the role each investment plays in achieving your financial goals. It will also help you avoid redundancies and manage your overall risk. And I think I have found just in our practice, Matt, that it's way easier for people to keep track of their investments when they consolidate it into a few accounts. And it's much easier to manage risk this way. So consolidating 401ks into your current employer's 401ks or consolidating the 401ks into a traditional IRA. The only thing people have to keep in mind is keeping your tax buckets separate, right? So if you have a pre-tax 401k, it has to go into a traditional IRA or another pre-tax 401k. And same thing with Roth IRAs and Roth 401ks. So that's the only thing that I think people need to be careful about.
Yeah, my only item I'd like to add for listeners is you kind of hear this old adage, don't put all your eggs in one basket. That's true, but it doesn't mean they can't be on the same farm.
Right.
Okay. So with that being said, you can have your assets with a single manager or custodian, and as long as they're not purely investing in one style completely, that's okay. And let me give you an example. So in the early 2000s, after the tech bubble, small and mid-cap value reigned for about 4 years, and it did really, really well. And so what do you think happened, Mark? A lot of people chased that style of investment. And what do you think got hit the hardest in 2007?
Exactly that.
Boom. And the problem is that there are managers out there that specialize just in that niche. And if you're all invested in that one specific niche, it becomes feast or famine. Mm-hmm. So my only word of caution is there's nothing wrong with having your assets with a single manager or firm, as long as you're properly diversified within that, and not in one style or niche of investment. That's my word of caution.
Yep, I agree with that. The next is getting strategic with your debt, and he recommends tackling debt in this order. Number 1 is high interest debt that is not tax deductible. For example, credit cards, which in my opinion are the silent killer.
Yep, I'm going to keep going. I agree.
Debt with private mortgage insurance attached. So try to get above that 20% equity in your home to eliminate your PMI.
Correct.
Next is high interest tax deductible debt, such as some student loans or business loans.
Okay.
Next is reasonable and low interest rate debt, 4% or less, that that's tax deductible. So many student loans and mortgages.
Got it.
Anything to add to that?
My 2 cents is for people in their 30s, I would be attacking all of those down to the last category. And I'm not saying that the sub 4% tax deductible like a mortgage shouldn't be. I think that I would want to be saving 10% of my income first, my opinion, before I would start really tackling the mortgage harder than that.
Yeah, because I think it simply just comes down to the calculation of, hey, can I make more than, say, 4% by investing this money? And usually over the long term, right now, I think that answer is yes.
Yeah.
I think it'd be a different conversation if, low interest debt that's 4% today is, 10%. If low interest was considered 10%, then that'd be a different conversation. But that's just not the type of environment that we're in right now. The next is maximizing your retirement accounts. So in general, you should prioritize accounts with employer benefits and tax advantages before investing in others. Maximize your retirement investments in this order. Invest the amount to get a full match on your company retirement plan.
Agreed.
Contribute to a Roth IRA or deductible traditional IRA if you're eligible, which
Agreed.
grow tax-free. Invest the maximum limit on your company 401k.
I agree with those orders.
Yeah, and I think we talked about this a little bit last week about why Peter might recommend and why we might recommend contributing just enough to get the full match of your 401k and then funding your IRAs completely before going back to the 401k. And that has to do with investment flexibility, which we talked about last week. So if people want to hear that conversation, go back to episode number 91 to hear that conversation on why Matt and I feel like that's a good idea. And the last thing I'll note here, Matt, and again, talked about it several times before, but if you still have money to save above and beyond those things, take a look at health savings accounts. So if you're covered by a high deductible health plan, it has a triple tax advantage, after tax deduction on your contributions, tax-free investment growth, and then the tax-free withdrawals if they're used to pay for qualified medical expenses.
I'm in agreement.
The next is making the most of your cash. So the trick is figuring out how much you can put away while still having enough liquid cash on hand to meet immediate needs. Most people find that a cushion between 25% and 50% of a month's expenses is enough to cover fluctuations, but you may need more if you have an irregular income, which we talked about before.
Yep, we talked about this.
Most financial planners also recommend an emergency savings account of 3 to 6 months of expenses. It's best to keep an emergency fund in an online savings account separate from your primary checking so that you earn a higher rate of interest and make it slightly harder to tap the funds for non-emergency purposes.
Did you subwrite this article for him?
Yeah, I know. And I didn't read this before I said that. That's just something that I've done for the past several years. So
I think you ghostwrited this article.
I wish I could say I did. And then I think the other thing to note here, Matt, is that yes, you want to have enough in emergency savings in case anything comes up, but it gets to a certain point where holding too much of your assets in cash makes it difficult to, number one, stay up with inflation. And number two, it makes, it difficult to meet your needs for retirement. So I think people really have to walk that fine line of being honest with themselves, saying, hey, if I have enough in cash in the bank, then I need to be investing anything above and beyond that number, because what people get into a situation is they end up with a couple $100,000 at the bank and they've never invested that money. So they're not going to invest it in retirement. So they're just going to be consistently drawing off that money. And with interest rates this low, there's a very, very possible chance that they run out of money doing that. And I think that, people just need to be careful that the only risk is not of risk of loss in the markets. It's also there's a risk of not having enough money or not growing your money quickly enough.
You're going to lose purchasing power.
You're going to lose purchasing power, and there's a chance that you're going to run out of money because, we know what the academia world says, that the closer you get to retirement, the more and more conservative you should get with your investments. But could be an argument made that that's also doing a damage to yourself in this low interest rate environment that we're in.
You know what? I think a lot of that is CYA for people in the money management industry. Is I think the reason that a lot of these quote unquote lifestyle or life path funds, I mean, you can get me on a soapbox with that. But it's like at the end of the day, I'm sorry, but someone who's 65 and only has 20% stock exposure, I want you to put me in a debate against a manager of a life path fund on stage, live stream it on YouTube, and put me against him. And it's not going to be pretty.
Yeah. And again, it's just that has worked in the past, but just right now we're in a different environment. You know, we're no longer in an environment where people can consistently count on, 7 to 10% in income per year.
If you're only 20% stock exposure, not going to happen.
Right.
Not going to happen.
Next is planning for the unexpected. So he says nearly everyone with a spouse, partner, or child needs life insurance, and you are better off choosing term life insurance rather than a permanent life insurance policy. You also need some form of disability insurance to protect you from an accident or illness that takes away your ability to work. And typically, Matt, larger employers have group disability insurance that you can just sign up for when you start. So I would encourage people to take advantage of that if you're not already doing so.
I got one thing on the term insurance I want to throw out there. Yep. I agree. I think most people in their 30s, I would be focused more on term rather than permanent is my first comment. My second thing is a lot of people that I meet that are in their 30s that are especially married and or married with children tend to be underinsured. And unfortunately, in our industry, Mark, you and I have seen situations where families have lost a loved one. And doesn't necessarily need to be the quote unquote person who brings home the income, and have been really, really impacted by the lack of coverage. And today, term insurance is very economical. You and I are not big insurance guys.
No,
okay?
We're not.
We're not. But there has to be proper coverage to protect that family.
Right, exactly. Because I think you need to look at it as, if something happened to, let's say, you today, what is needed from a monthly income basis to provide your family with the same lifestyle that they're living today.
Exactly.
And I think that's what every person has to go through. And sometimes that's upwards of 8, 10, 12, sometimes even 15 times your annual salary in life insurance.
Agreed.
And again, I never want people to be, wasting money and overinsured and that type of thing. But, like you always say, we hope we're wasting our money with these monthly premiums and nothing happens to you, but you have to prepare for the unexpected,
yep.
Right?
Just want to throw that out there, especially people in their 30s. I tend to see that more often than not.
Yeah. Develop an estate plan to protect you, your family, and your stuff. If you have minor children, an estate plan is important beyond monetary reasons because it allows you to name the kid's guardian in the event of your death. Otherwise, the decision is up to the state. So there's kind of 4 key estate planning docs that we recommend everybody have in place at the minimum, Matt. So obviously that is a will, a living will, healthcare power of attorney, financial power of attorney. And then the other thing that we get asked about a lot, Matt, that I want you to touch on briefly is trusts. Mm-hmm. So in your opinion, when does it make sense for people to put their assets in trust rather than just having a will and having beneficiaries listed on all of their accounts?
So the primary reason that people want to or need to have a trust is to control the distribution of their assets beyond their passing. That is the main reason. Now, it also, if things are properly titled, it makes sure that things avoid the probate process. It allows you to settle the estate a lot quicker. But the primary trigger or motivation for people to do this, Mark, is be able to control those distribution of assets. So let me give you an example. Instead of something happening to Rachel and I simultaneously, and, let's say my kids were older, above the age of 18, instead of them getting all that money up front at the time of passing of spouse number 2, we could write into the trust that they get income for a certain time period until they're older and hence more responsible with inheriting, that type of wealth. Makes sense? And so with that being said, I would say listeners, controlling the distribution of wealth beyond your passing is one of the big reasons I tend to recommend that someone consider a trust.
Yeah.
And again, we're not attorneys. We can't draft these things. We just have the education to understand, what they do and when we should refer them to the proper legal counsel.
Right. Or if, the parents own like a business, for example, if something happens to them, then, there's a process for the sale of the business, the proceeds go into trust and are there for the kids. That's another common thing that we see. But I think that, if your financial situation's pretty straightforward and you're not worried about the control of assets, passing it on to the next generation, then a lot of the times then a trust just doesn't make sense.
Yeah.
If you have beneficiaries listed on your account and in your wills, you have all your stuff listed on how you want to go and the control is not important to you, then a lot of times I don't think people need to spend time getting a trust.
Yeah, I mean,
place.
We could have a client with 7-figure net worths that don't require a trust. Right. And, just because you're a quote unquote millionaire plus doesn't necessarily mean that you automatically need a trust. Right.
Yeah.
So, I want to make sure we get rid of that narrative. The other thing I want to throw out there is, there are probably some people who are listening to this podcast right now who think, okay, if something happened to me, who would I name as that successor trustee? And if you don't have anyone in mind, there are corporate trust companies that can step in and execute your wishes beyond your passing. And so it doesn't necessarily need to be an individual, and we can provide referrals for that. And, we have no vested interest. It's just an added service that we have. But I want to throw that out there because I think a lot of people struggle with that.
Yeah, especially for someone that doesn't have family around anymore or someone who isn't close to their family. So, they're trying to figure out if they name, a friend. But
and sometimes they don't want to be. They want to be, Switzerland. They want to be neutral.
Yeah,
they don't. They have 2 kids. They don't want to name one and upset the other. Could be friends, but that's another reason why I see it.
And it's a good way to use a company. It takes the emotion out of it because that's their job. They can look at that objectively and not have any issues executing that. Right.
Good point. Good point.
I think that's it for me this week, Matt. Anything else before we leave it here for the week?
I do not have anything else. It's just nice to see spring finally hitting the Midwest here. Temperatures are getting up to the 60s and 70s in the afternoons. And when I talk to people in the South, I can finally turn the page and say, listen, you're about to be 100 degrees every day sweating and I'm not.
Yeah.
So the page is turning, my friend.
Yeah, it's good. It's good. Spring is in full force, I think, here. It's going to be nice this whole week, and hopefully it's not just another fake out for us.
I'm going to start getting nasty grams from our friends and clients in like California, Florida, Texas right now.
I know.
I can see them coming later today.
I know. I mean, it was just snow. It was snowing on Thursday last week.
It was.
And
we were at lunch with lunch with Nick.
Yeah,
I remember that.
It was 75 and sunny yesterday. So.
Yep.
But all right, well, we'll leave it there for the week, and we'll be back next week for the 93rd episode of the Independent Advisors Podcast. Hope you all have a wonderful, safe rest of the week and weekend.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.